Hi, this is Jim Pearce, Chief Investment Strategist for Personal Finance with a weekly update on Friday, January 5th, 2024. Since hitting an all-time high last week, the S&P 500 index backtracked a bit during the first week of this year. That's understandable given the magnitude of the stock market's rally over the last 2 months of 2023. As a result, the index opened this morning very close to its 50-day moving average near 4,700. So here's a chart of the S&P 500 over the past 6 months. You see the big drop there at the end of October and then the steady rise since then. But if you go all the way over here to the right, you see it peaking around December 27th, 28th. And then if I'm going to zoom this down to 1 month to make it a little clearer. Not a big difference, but you can see it cresting and just starting to come down. So after falling for 3 straight days, the index is up today after the release of the December jobs report, which I've included a link to here. Last month, the workforce expanded by 216,000 jobs, while the unemployment rate held steady 3.7%. Now, both of those numbers came in a little better than expected, supporting the notion that the economy is on solid footing. And by better, I mean people were expecting maybe like a 1/10 of a percentage uptick in the unemployment rate and more like 175,000 new jobs and not 216,000. Now, at the same time, wages rose 0.4% last month and increased 4.1% during the past year. Now, both of those numbers exceed the increase in the Consumer Price Index reported last month, which in here I have a link to that report just so you can go back and refresh yourself since it's been a few weeks since it came out. But it rose 0.1% in November and increased 3.1% over the prior 12 months. So that means consumers are no longer losing purchasing power to inflation, which bodes well for corporate profits this year. If inflation is going up 3.1% and your income's going up 4.1%, over the course of the year, you're gaining a little bit of purchasing power. More importantly, you're not losing purchasing power. However, that also means that the Fed may not feel inclined to start cutting interest rates as soon as Wall Street expects. If the economy can expand on its own without the help of lower interest rates, the Fed may leave them where they are to keep downward pressure on inflation and finally just be done with it once and for all. That appears to be what the bond market believes. Since bottoming out below 3.8% last week, the yield on the 10-year Treasury note is back up above 4% today. That's not a big increase, but the change in direction over the past week signals an end to the recent drop in bond yields that began in October. So again, here's a chart of the 10-year Treasury note over the past 6 months. You see this peak right here, also in late October, and then the steady decline until, again, December 27th, 28th. So you can see this little uptick here over the past week on the far right. And again, if I zoom into 1 month, you can see the bottoming out process. Again, not a big change in number, but it is a change in direction. Now, also coming to an end is the decline in energy prices that drove down the price of a barrel of crude oil from above $93 in September to below $68 in December. Last week, it traded above $76 and appears to be stabilizing between $70 to $75. Now, at that price, energy producers can be profitable, while the average price of a gallon of regular gasoline in the United States is a little over $3. So here's a link to the U.S. Energy Information Administration. They track prices around the country. And if you look down here at the bottom, retail petroleum prices, just regular gasoline, an average price of $3.09, and diesel, which most people don't use, some do, but at $3.97. But regular gas, just a little over $3 on average around the country, maybe higher or lower, of course, where you are. Here's the important thing. All those numbers are conducive to a healthy financial system. A bond yield of 4% is sufficient for most income investors, while paying $3 for a gallon of gas is affordable for most consumers. The housing market has not collapsed despite higher mortgage rates, and employment has been largely unaffected by higher interest rates too. In short, no one sector of the economy is subsidizing another sector. The stock, bond, and commodities markets are each trading on their own merits based primarily on market-based supply and demand. For that reason, there are no major distortions present in the global financial system that pose a threat to its stability at this time. And it's been several years, really, since we could say that, especially while the Fed was driving rates very low at the onset of the coronavirus pandemic and then driving them higher over the past 2 years to offset that. So this is good news. This is a good way to start out the year. Of course, who knows what might come up later this year that could change all that. But right now, actually, the financial markets, to me, appear to be balanced, fairly valued, and able to, again, work on their own without any kind of subsidy or support from the Fed or anyone else. So that's this week's report, and I look forward to talking to you another week. Hope everyone had a wonderful and safe New Year. And if you have any questions, feel free to email them to me. Thank you.